Hi, this is David from Critical Trading. Thanks for joining me in today's video. In today's video, what I'm going to talk about is one of the key mistakes that people make when they are developing a systematic or algorithmic trading strategy. It's a mistake you absolutely have to avoid, and what I'm going to do, I'm going to show you what it is and what to do instead to avoid it and to give yourself higher chances of success. Depending on how long have you been interested in algorithmic trading and how much experience you have, you probably experienced a situation where you developed a trading strategy that looked very promising, and it had really promising backtest results to the point where you kind of thought that it's too good to be true. And as soon as you started to trade that strategy live, the performance was anything but close to the backtested one that you were hoping for. Now, there may be many reasons as to why this may happen. The unfortunate reality of trading is that trading strategies or their edges evaporate over time. So there may be many different reasons as to a strategy's performance may not be close to the anticipated performance that you kind of modeled in your backtest. One of the most common reasons is simply over-optimizing the strategy. So let's just take a simple trading strategy. This is a mean reversion trading strategy. I predominantly just research and trade mean reversion these days because that kind of trading strategy really suits me personality-wise. And this particular strategy trades all stocks that belong to Russell Micro Cap Index. And it basically looks for a stock that is showing a degree of longer term momentum measured by the rate of change of the closing price, but I'll get to that in a second. And it basically then tries to enter using an indicator called RSI. When the RSI gets below a certain level, then the strategy places a limit order for the next day 3% below the closing price. So it's a very simple strategy. There's a couple more rules to it, but the strategy itself is not important for the purposes of this video. An actual trade that the strategy made is in this particular stock that we're looking at here. In particular, the strategy bought at this level here, and then the strategy sells the stock on the first up day following the entry, which is one of my favorite exit types that I use in my mean reversion trading strategies. Strategy is looking for a certain degree of momentum in the market. It measures the momentum using rate of change of the closing price, which is the indicator that I just plotted below my price chart. We have the rate of change based on close of the past 25 trading days. And also we have a horizontal line which is plotted in that indicator pane at the level of 5, so at the level of 5%. And essentially what this strategy is doing is that it only takes trades if the rate of change over the past 25 days is greater than 5%. But now going back to the topic of this video, which is the mistake that most people would do when building a system like this. How do you determine what exact period to choose for the rate of change? So in this particular case, we're working with 25 days, but you can pick 20, you can pick 30, you can pick 5, which exact period to pick, and also which level to pick. Now, what most people would do, they would run what's called an optimization of the parameters. So they would test various versions of this strategy with different parameters. So they would test rate of change that's based on past 25 days, but with a level of 2%, 3%, 4%, and so on. Then they would move to a different period of the rate of change with different levels, and so on. You get the idea. Obviously, you wouldn't be doing this manually. You would be using specialized software to do so. I use what's called AMI Broker, which is a software of my choice. So if I then go and look at the results of such optimization, what we get is this graph here. And this basically shows the different versions of the strategy with different parameters, like I just described. And the y-axis shows the annual return percentage for each of these different versions of this strategy. This is based on just over 2 years of data starting from the beginning of 2020. And we can see that one particular version of this strategy clearly stands out which is visualized by the green vertical bar. And that particular version has clearly shown the highest annual return. And this is where most people would go wrong, because they would pick this particular version and go trade it live. What stands out in this particular case is that this particular value or this particular version is very isolated from others. So we can see the annual returns to the left of this value are much lower, and also to the right of this value they're much lower. So this particular version is very isolated, and what that may suggest is that this particular version has shown the highest annual return of them all just by coincidence, okay? If you run backtests of different versions of a strategy, logically there's going to be one that will be the highest in terms of annual return and one that will be the lowest. Let's quickly have a look at the equity curve as well. It looks very promising, but bear in mind this is only for just over 2 years, starting from year 2020. So what if we then go and take this strategy and test it on more data? So starting from year 2010, for example, up to the end of 2019. So this would have been the data that we didn't optimize on. And we take the highest performing strategy from the previous screen that I've just shown you, the one with the highest annual return. How would the equity curve look like then? And here it is. It looks nowhere as smooth as the one on the previous screen. Now, I looked at the performance metrics as well. I don't just look at the shape of the equity, and I can confirm that all the performance metrics are significantly worse than in the in-sample data that we originally tested on. But we can visually see on the equity curve that it's much more volatile and it goes sideways for a prolonged periods of time. So let's just go back to our optimization chart. And like I said, the mistake that most people make when optimizing is that they just simply take the highest performing value out of them all and expect that this is going to repeat in the future. So what you want to do, instead of picking the highest annual return, is you want to pick a combination of parameters in a more stable area on the chart. So let me show you what I mean. So I would definitely not pick this particular value, because it's just simply too sensitive. It just stands out too much, which makes me to believe that it's just a coincidence. Then obviously I wouldn't pick anything here, because we can see a clear trend on the chart. The values are simply too low when compared to the values on the right. And what I would do instead is I would pick something from this particular area. The reason why I would do that is that I can see that the values here, represented by the vertical columns, are stable. And then let's have a look at the equity curve associated with one of these values. Again, the equity curve is based on the unseen data, so starting from 2010 to end of 2019. And we can see that the equity curve looks much more different to the equity curve of the best performing in sample iteration of this strategy. And also all the performance metrics are much better across the board, but you can see that visually on the equity curve itself. So the takeaway from this video, guys, is that the backtests are rough guidelines only, and your live trading will never match these. So just get that out of your head. What you should be doing when optimizing the strategy is don't just blindly take the best rate of return, or best Sharpe ratio or best win rate when you try to optimize a strategy, or when you try to find the best performing parameters, but rather focus on the parameter sets that are in the stable area, similarly to what I've shown you on the chart, because these have much better chances to survive in the future. Thanks very much for watching. This is David from Critical Trading, and I'll see you in the next video.